Whether investing is something you're considering beginning for the first time, you'd like to improve your performance with, or consider all the different opportunities available, this webinar is designed to cover some of the different asset classes that are saliently available to you. A quick disclaimer, and an important disclaimer: this is general advice. As such, it does not take into account any individual's personal needs, circumstances, or situation, and certainly not their goals. Should anyone wish to make investments in 2019, always make sure that you've taken the right sort of counsel. That could include taking a statement of advice from someone like a financial planner to look at what might be most appropriate for you. This is general advice and doesn't constitute advice that you should base investment decisions on. When it comes to asset classes, you can group them together, and the four most common categories, if we, for example, take away something like alternative investments and leave that on the sideline for today, the four broadest asset classes that are worth categorizing together are property, fixed income, which is often sort of seen as debt, equity, i.e. shares, ownership or part ownership of a business, and cash. Each of them over the last 90 years has had its own trajectory, and as you can see on this slide here, cash has performed an average of 5.5%, and clearly that is an average in terms of totting up each year, so some years would have been higher than others. Next best performing, if you're only interested in growth, is the bond market. That's fixed income. That could be through private entities that need to borrow money, or it could be through sovereign entities, not least of all the Australian government. When it comes to the top performers, very similar overall. We have the Australian equity market, 11.3% over the last 90 years. And there we have in blue residential property, both performing at similar levels. Notice how each of them has had periods of retracement, but over the time period, there are different trajectories for each asset class. That makes sense because there are different reasons to be in each one. They offer different investment vehicles. When it comes to cash, all of us like the ability to have liquidity and to be able to make daily transactions. So every single investor in the country will have some level of cash. In terms of what that means, you will have savings accounts, checking accounts, and you might even sign away some money in the arrangement such as a term deposit where you have some sort of barrier to readily accessing that capital, but you will be offset that disadvantage with hopefully a level of interest payment that makes it amenable. Cash is always going to be something that people want to consider, not least of all because there is the obvious huge advantage that there are guarantees at $250,000 from the government for any particular level of cash savings. So that means that there's very low risk that the capital will be lost, even though financial institutions such as banks lends that money that you give to them, there is that guarantee. When you look at the performance of cash over particularly the last 20 to 30 years, you'll see that there have been peaks, and it doesn't always need to be downward trending, but certainly in the last decade, cash has not rewarded investors particularly well. With the RBA seemingly pretty content to stay at a 1.5% cash rate, it's entirely logical that you will continue to have low return on cash. In an ideal world, you'd be able as a retiree to take $1 million to the bank and hope to live off somewhere around 5 or maybe even higher % each year. $50,000 from $1 million invested is not too bad, particularly if you've paid off your home. At the moment, it's much, much lower, the rate that you'll get even with long-term deposits. So it does need to be considered that if you're looking for 2019, the range of forecasts from a number of top economists and institutions would seem to form a consensus that the RBA are unlikely to move particularly soon, and even if they do, it wouldn't be particularly aggressive. There is even a suggestion, and if you look at excellent commentators like Dr. Shane Oliver at AMP, that there may be logic behind an easing bias and the RBA looking to reduce rates before they increase them. Alongside cash, another asset class that many of us look at for a couple of reasons, for the coupon payments and also likewise for capital growth, is the fixed interest market. So the debt market, the bond market, all effectively interchangeable synonyms, relates to the concept that there are different entities, whether they're private or they are state or federal, that would look to borrow money. You borrow money to, as a firm, invest and improve your capital and the equipment you have. Likewise, as a government, you often need to spend outside of your tax revenues. So when it comes to the bond market, there are different options. You can look for riskier and therefore offering higher yield investments, or you can look for typically the safest would be when it comes from the federal government. The chart that we have on this slide covers the 10-year bond yield. So the yield is the difference between what you paid for the asset and the yield, i.e. the payments that come from it. So in this case, the coupons. As more money goes into the bond market, for example, here with the 10-year, as the prices go up and up and up because there's more and more demand, the yield will come down. And that's due to the fact that there are such low yielding assets from term deposits, for example, that bond investors are happy to get into a 10-year, even at lowish yields. So you'll see there, it's been shrinking throughout that time period. The beauty of different fixed income assets is that there should be a reasonable longevity to the trust that's associated, particularly with sovereign yields. When it comes to a different asset class, let's look at property. Now, property has tremendous advantages. There is owning direct property, and if you would like to, you could even look at real estate trusts where there are pooled capital from shareholders and able to invest in a range of different properties. Not least of all, they don't need to be residential. They could be commercial or industrial. The beauty of property as an asset class is that it has typically performed exceedingly well. And that is a product of a number of factors. It's to do with supply, how many units have been created, and it's also to do with demand. Migration and demographic factors, meaning that more people would like to live on their own and that there are more people looking to live in urban areas, has created further demand. And demand is also a product of lending restrictions. How likely is an individual or a family able to get the lending that they need from any financial institution to make that acquisition, to make that purchase? It's an asset class that's very tangible. It's done exceedingly well over the last 20 years in Australia, as we'll see on the next slide. If you look at Sydney, if you were able to invest in property anywhere around 2009 onwards, it has done incredibly well. For some suburbs, the performance is up over 70%. So that's excellent under the time scale. And that's as an index. There will be examples, I dare say, where the house price in under a decade may have doubled, which is by any measure an exceedingly good performance. House prices are cooling at the moment, and there are a number of reasons for this. One would be supply issues, that there might be more units coming onto the market. Others are to do with borrowing. If individuals are concerned about moving away from an interest only and having to pay the principal, they might be looking to offload the property. There are also the extent to which there are demand side factors. That could be international buying, that could be domestic buying. With a lack of wages growth and with tighter lending restrictions, there's an argument that there is less demand or ability to purchase those properties. So if you look at the economic data available to us, there is every reason to suspect that 2019 could see further softening of house prices in areas such as Melbourne and Sydney. Now, that's talking in aggregate terms. There are always going to be outlying suburbs, outlying investments, but on aggregate, the average performance is likely to be a downwards performance for property, certainly as investments. And one of the arguments will be, will Labor look to change negative gearing should they win the federal election? If that does change, then again, the incentives to have an investment property, even one where the tenants are not covering the mortgage, is altered. One asset class that has always been incredibly popular and forms a large proportion of many superannuation accounts is in equity of listed businesses. The beauty of part ownership of a company is that if the company does well and if they're able to pay dividends in that process, you may, with the cash that you acquire the shares, find that the shares are worth more over time. There are a number of reasons for this. Obviously, the beauty is that you are appointing experienced and professional executives to run the asset, and they are able to allocate capital prudently. In terms of as an asset class, it is incredibly popular, with around about a third of Australian owning shares directly. I think the ASX ascertained in 2015 that there's somewhere in the region of 6.48 million unique holders of Australian equities. The beauty of the equity market is that it inherently gives you choice. You could argue even too much choice. You have choice about when to enter. It settles very quickly. You have no barrier to entry in the sense that unlike property, you have only a $500 minimum parcel, and you have naturally choice over different sectors. On the Australian exchange, the ASX, you're able to make the distinction between investing in a direct business with listed managed investments. There are exchange traded products, and you also have the choice to look at fixed income assets. Some of these ETPs and some of these fixed income assets also consider international exposure. So you can, through the Australian exchange, be leveraging the thematics of emerging markets or the NASDAQ, a number of offshore premises as an investment vehicle. Should you wish to invest in equities, or indeed, given that the ASX covers fixed income and listed managed investments, there are so many ways to do this. One is to navigate the exchange using a discount brokerage firm. There are smartphones with applications that allow you to go through a lot of data and to make your own selections, and then that entity on your behalf will register the transaction. You could invest through a managed fund. So you are able to appoint a professional manager of the investment, and they will charge you fees to do with administrative performance and the management of that investment. Or you could, in your own designated account, work with an advisor to help you make decisions. So there are a lot of different options if you'd like to be investing in equities. The beauty of working with a discount brokerage firm is that you have a lot of choice, a lot of control, and in terms of transactions, you will typically find that the cost is reasonably low. Different firms offer different packages, but there are often incentives to join, and it's certainly incredibly popular. Now, not to say that there are huge volumes that go through in terms of the value of all of those transactions. Obviously, institutions are more valuable in terms of the daily value of everything that's exchanged, but there are so many transactions happening all of the time that retail clients using a discount broker account for around 58% of the transactions on a daily basis. Now, using a discount brokerage platform has many advantages, but you would also acknowledge that there are certain weaknesses of that experience. One would be that you need to make the decisions yourself. Now, that leads to all sorts of behavioral economics and certain logical fallacies that we can subscribe to that allow us to potentially harm our capital that's engaged in the market. That could be being too emotional and therefore risking investments, whether that be to stay in certain too long, to transact too often. It involves making so many decisions that you could be underwhelming yourself in terms of capital growth. There is also the challenge that it takes time and energy and resource to come up with the investment hypothesis. If you do so in a vacuum, there's a risk that you're buying in to your own confirmation bias. There's also the challenge that it takes time and energy to come up with the counter arguments. So there are reasons to consider and reasons to be cautious about working on your own through a discount brokerage platform. So another option would be to work with an advisor. The logic of working with an advisor is that they should be fully immersed in the market, and they can work with you to give you general advice or personal advice, or they might, if you have that arrangement, a managed account, they are able to come up with different investment ideas that you might not have the time, the energy, or the experience to come up with. So the ultimate goal of working with an advisor is to outperform what you would be able to do on your own. There's also the logic that since they are in the industry and they have seen different investment hypotheses before, they might be able to provide that dispassionate and logical counsel that allows you to outperform. The challenge, if you're about to appoint an advisor, is to ascertain which advisor would be most likely to help you. How do you pick a good advisor? It's quite a challenge, and obviously you need to do your due diligence. Advisors range in experience, they range in their own opinions and particular areas of the market and sectors that they are fondest of. You want to hopefully find an advisor that will work extremely hard, will act in your best interest, and they will be able to communicate with you at the level that you require. That could be in terms of regularity. It could be in terms of being able to explain to your level of understanding. Whether you are extremely knowledgeable, you might be a professional accountant, you might sit on boards, right through to many investors are brand new to equity investing, and they might have many questions, and they might like to know even simple things that obviously are difficult if you don't know and you're new to the area. Another option for the investor that would like to have access to equities is to invest through a managed fund. Now, there are listed managed investments which operate rather like a stock and allow you to enter and transact very often. And there are managed funds that are not listed where you might be buying in with, say, $250,000 or $500,000, and they have their own mandates, i.e. they have a logic to what they will do with that capital, and hopefully they will travel well in that time period. The beauty of a managed fund is that you have professionals managing the investment. They might get access to different concepts and vehicles that are hard to find through the exchange. And likewise, they hopefully have a pedigree and an expertise that you're tapping into. So their logic is that they could perform better. And it's worth considering all the evidence available. Some of these, for example, mutual funds in the United States struggle to consistently outperform the market. And when you consider all of the different fees, sometimes the performance underwhelms or fails to outperform the market. Another disadvantage of working with a managed fund is that they typically can have large entry requirements in terms of capital to enter the fund, and they are designed to be reasonably illiquid in the sense that you'll be penalized if you want to access your capital before the maturity of the agreement has been reached. So they are not for everyone. Obviously, there's no control, and they will follow their mandate as they see fit. You can't sort of chip in and give your own opinions. Alongside all of the different concepts of how you navigate the market, there's different firms and different types of arrangement that you might enter into. The international brands are here in this country, the likes of UBS, the likes of Goldman Sachs and JP Morgan. And they have a range of different offerings to clients, particularly high net worth clients that might be able to tap into their expertise, whether it be through getting you into a suite of investment products or services. Another way that you could potentially work with professionals is through financial planners. Financial planners come in different shapes and sizes. They might be single entities or just a partnership, ranging through to those that fly under the banner of the largest financial institutions in the country. Financial planning as an industry is taking a number of reforms and overhauls within its stride. There's been the Royal Commission this year, and it is a space where there's going to be increased scrutiny about who is giving financial advice and why. At the best, a financial planner is able to tap into years of experience and provide personal advice that is of value to clients. It is, of course, a very complicated industry. There are big issues to do with incentives, fees, training requirements, and a number of factors. So it's probably an industry that's going to be very different over the next 3 or 4 years. In terms of getting ideas about the market, one of the excellent places that investors can look is through the mainstream media. We have in this country News Corp, and now with the Fairfax 9 merger, 9 carries the main sort of kudos as the brand. So you have AFR and Melbourne's The Age, the Sydney Morning Herald, all sort of available through 9. And in terms of the Australian and Sky News, there is also live media to digest. A lot of these journalists are incredibly well learned, and they're able to offer good insight to different vehicles and to interview CFOs, CIOs, all sorts of industry professionals, and also the managers of different funds, and likewise the executive team of some of the top businesses in the country. So having a subscription to some of these services is very popular, and it can certainly help in understanding different listings and the general themes in the market, not least of all in terms of a macro overview, how Australia or the global economy is traveling. I suppose there is always a counterbalance to anything. It takes time to read the paper every day, and these institutions are not necessarily set up to provide advice. They're there as a sounding board so that you're across the salient news of the time, and likewise, you would then need to navigate how exactly you interact with your investments, whether you're investing in any one asset class, whether you are registered on the exchange. There are excellent investment firms in this country that are set up to provide guidance, particularly when it comes to investing in securities. And alongside working with investment firms, there are advantages and disadvantages. You need to be conscious of what exactly you are getting from the membership, what exactly are your aspirations and your weaknesses, where can you find value with an investment firm's advice. Many investors that like to look at trading and transacting through a discount brokerage firm would like to get access to subscription services where they can find through a reporting tool or a reporting service, the cataloging of articles and editorials, some guidance as to exciting opportunities that are potentially overvalued, and in general, again, tracking how the overall market is traveling. The beauty of these services is that they give you a little bit of choice so that you can then make the transactions yourself. And in the yin and yang of life, a lot of people like that. But I suppose the disadvantage is that some of these services might be covering hundreds, if not thousands of different listings all of the time. So it can be a bit of a maze to navigate which opportunities are of most interest. Based on all of this, KOSEC was founded with the aspiration of providing clients with a transparent service of general advice so that clients can learn a lot more about different listings and whether or not they understand exactly why they might be under or overvalued. The logic is to look at the ASX 300, which gives us hopefully decent amounts of scrutiny from auditing firms and likewise the exchange and ASIC. There should be decent amount of liquidity, and hopefully these are some of the top performing firms in the country. The logic that we apply, and I think it's important to have a strategy in whatever investment vehicles you look at in any asset class. When it comes to looking at equities, we follow a top-down investment approach. By top-down, what we mean is that we first of all focus on macro data points, whether that be to do with unemployment, wages, whether that be to do with underemployment, whether it's to be to do with inflation, balance of payments, or looking at flash PMIs. We are in the business of helping clients to understand how the data points steer the economy, whether it be that we are particularly bullish or bearish on any one sector, or if we're conscious that new laws or treaties or regulations could impact any one space. Once you isolate, for example, an area, a sector on the exchange that you are confident could outperform the overall index, it's worth considering, though, that not every business is likely to fare equally well. They all have unique propositions, different management teams, levels of debt. So looking deeper and conducting fundamental analysis of each entity is often worth your while. Now, there are different metrics and each of them has their rationale. No one metric is perfect in isolation, but if you can holistically look for certain qualities in a business, it's likely to be the case that you get a good flavor as to how the business has operated in the past. So it's the same, and it's analogous to any sport. If you're looking for a business that typically pays down its debt and invests wisely where possible in sensible acquisitions, if you're looking at a business that is able to protect its margins and to grow revenues by entering into new spaces or eating into the market share of its competitors, if you can find a business that is able to protect the dividend or grow the dividend, these are the sorts of businesses that you think could be well-run assets. It's worth looking at them as potential capital growth candidates. Then you want to consider, arguably, when you would like to enter a business. Now, there are different ways of looking at value. One way is to look at what does the rest of the market feel? Is there a consensus from institutional research desks that there is upside for this business? What sort of broker calls do they have and what target prices? Likewise, you can conduct technical analysis where you're looking at moving averages and other statistical tools to try and ascertain if a business has traveled well over a certain time period and where you think it might be overbought or undervalued. So adding all of this together, if you have a top-down approach looking for quality at a decent and logical entry point, you have layers of evidence to suggest that a particular investment, whether it be in a stock, whether it be in an ETP or a listed managed investment, could be a logical and sound place to diversify and find value. An example that's worth considering is ResMed. Now, ResMed are in the production of sleep apnea products and devices, and they also have research and development that incorporates a lot of data about client sleep. As an entity, let's look at a few different metrics. In terms of sales per share, over the time period catalogued from the financial year 2013 to 2018, you can see that sales per share consistently grow. That means that the revenue that comes in is on the up. Now, earnings is also worth considering as well. Are we a more profitable business this year than in the past? And again, there is a consistent growth. The margin is very steady and oscillates of a low from 25 all the way up to 34.6. So as a margin there, that is excellent and shows you that they are able to keep their costs at a sensible level and able to provide excellent level of revenue. Return on equity is very strong and would be above the market average, and the debt to equity is, there is more debt than some entities on the exchange. Debt is also, it's worth acquiring at times when it's cheap and allows the business to make excellent acquisitions, but that has been paid down. So as you can see, with fundamental analysis, ResMed is an extremely well-run asset. Now that is always backward-looking, and history shows us, and investing, we must recognize that the past is no indication of the future. But likewise, you're able to pick a business here where with the announcements that they make, with their reporting schedule, you're able to drill down into the numbers and see that there is a quality and a logic to how this asset has been run in the past. So our service involves a number of features so that you can hear about how ResMed is traveling in the future, and likewise, hopefully trying to identify a different ResMed in every different sector as often as possible. In order to do that, we create a number of different intellectual property publications. We have daily market wraps, we have weekly summaries, we have ad hoc opinions on a number of different investment vehicles, and we produce a monthly report which covers editorial content. It involves summaries of the macro data points throughout the month. And likewise, it catalogs a series of different investments and explains a little bit about them in terms of management team, in terms of the fundamentals, and what other institutions feel. Once we've published a report that you can read at your leisure, we inevitably realize that people will have questions. Those questions could be about interpreting the data. It could be asking about when dividends are paid. There could be a range of different reasons you'd like to speak to someone licensed to give general advice. We've created a service where we have dealing assistants that are in our office every single day that the ASX functions in this country. So there's no danger that an advisor is unwell, absent, playing golf, or on a boozy lunch. You will always be able to speak to someone licensed to give you sensible, factual advice and general advice about what's happening on the exchange that day. Were you to join our service, you'll also be given a full account analysis, as in which prior investments you hold, giving you full general advice about the merits of each of them in terms of their current share value and whether or not we think that they are under or overvalued. You work with experts, and our finest expert in the team is the founder, Michael Kodari. He's appeared on live business television and as a pundit in a number of different vehicles, and he's been able to give you excellent stock picking guidance. You get full administrative support. So if you need to access different statements, you are given excellent support. So there's never any danger about completing your tax returns or being unable to source different documents. And in terms of the account, you have full control. So it's established in the name of any entity you see fit, whether that be an individual, joint, or trust account. And you're always able 24/7 to view all of your positions all of the time. As well as investing in listed securities, we're also able to provide, should it be in the interest of the clients, as in not everyone finds it exciting, but we have access to corporate finance opportunities. So this is potentially investing ahead of the market. We filter the ASX all of the time, looking for the right opportunities. Opportunities to potentially lighten positions, given that there could be concerns about the future performance of the individual listing, and likewise opportunities to invest, to allocate capital where there is a rationale and there is the evidence to feel that the asset could perform well over the next few months and years. As touched on previously, we are conducting daily market wraps, and the team are always in the office looking for opportunities. And finally, there is the Kodari Lifestyle in Investments magazine, which gold clients will get access to. It covers a lot of our brand partners and special events that are happening all throughout the country. You'll also, through the Kodari magazine, have a series of conferences, seminars, and meetings where we're able to meet with our clients and explain all of the research we're conducting and where we feel opportunity lies in the market. To give you an idea of some of the performing statistics that we have, I'll just run through some of the different publications and stocks that we've highlighted. So in 2014, on the 6th of January, Michael Kodari was able to share with the Business Channel a few opportunities that he thought were interesting, and these included the likes of Vocus, Domino's Pizza, Ramsay Healthcare, and TPM, which is the stock code for the telco TPG. When he was invited back on in March 2016, if you look at the performance, those 6 distinct listings performed exceedingly well. Now, Amcom was actually acquired by Vocus, but if you were able to invest in each of those different listings, the aggregate performance would be a 93.77 average return. That assumes that you allocated the capital equally. Now, did the market have a bull run in that time? Well, actually, no. The ASX 200 was down during that period. So it's worth considering that the market as an index was down, but those 6 stocks performed exceedingly well. And then back in 2017, for a recent sort of media campaign and advert, again, the team looked at, and Michael Kodari selected 7 individual listings that he thought were undervalued at the time of the 1st of September. These were the A2 Milk Company, the financial institution ANZ, which obviously many people see as a great sort of opportunity for yield, Aristocrat Leisure, Cochlear, NIB, Northern Star, and Qantas. Those 7 stocks were published as a research document that we gave to anyone that liked a TV commercial and wanted to learn more about equity investing. And the aggregate performance of these 7, if you were to allocate capital evenly, was 30.05% in that 6-month period ending in February 28th of February 2018. Again, the index had a reasonable run in that period, but not to the same level. As such, you can see that we've worked exceedingly hard to provide general advice over 8 years. This is our 9th year as a firm, and our mission is to make sure that we're allocating as much energy as possible to be innovative, to have a well-trained, hard-working team providing compliant and logical advice so that investors can get asset classes such as equities and fixed income securities as part of their plans. We'll be busy in 2019 making sure that we're studying as much as we can what's happening and helping people understand and appreciate and hopefully transact in investments that we think can outperform the market. Thank you so much for your time. If you have questions, please get in touch. You can contact us on telephone on 02 9955 3151, or you can send an email to info@kosec.com.au.